Ladies and gentlemen, welcome back to the channel. Stocks recovered into the end of the trading day, including Tesla stock. Now, tomorrow is the big day for markets, and here in this video, I will give you the 360 overview, what to expect for stocks, and how the jobs report could come out. This could be a big catalyst for Tesla stock, and I think I have some insight into this that you need to hear. I will also go over final option activity on the day today for Tesla and why I'm viewing this market as being volatile in September, as some of the downside we've seen recently is very much a positive indication for this bull market. Ryan Dietrich went on CNBC today and essentially said the exact same thing as what I was thinking. So I'm going to share that clip, and I have one more clip as well to share with you on CNBC today. Hit that like button and subscribe to the channel. Let me know your thoughts on all of this information down below in the comment section. If you want to take it a step further, come check out that link down below in the description of this video. Keep in mind, if you blindly follow anyone, even though we're outperforming 99.9% of Wall Street hedge funds and institutions, our year-to-date performance is like 94%, something outrageous, okay? And I think it's going to be over 200% year-to-date by the end of this year. With all that said, it's not a recommendation. It is not financial advice. If you blindly copy someone and don't understand the companies you're investing in, you will probably lose all of your money. I'll take it a step further. You'll probably lose all of your money and end up sleeping under a bridge. Please do not do that. You know how many people, even in the comment section, are like, oh my gosh, you said this and it didn't happen. And next thing you know, they sold out on the first red day. And then the next day later, stock's up 20%. It's like, whose fault really is that? Did I say what I said was wrong, or did it just take a little bit longer? So come to your own conclusions. That link is down below if you want to check it out. By all means, check it out. Let's go ahead and get into today's episode. So first things first, as I've talked about many times before on this channel, September's a weird month, okay? It's the worst month since 1928. It's the worst month in the last 10 years, 20 years, 5 years, like all of recent history. It's just a bad month. The algorithms control the trading volume in markets. So they have a heavy bias to sell stocks. Now, the good news is we have a very positive backdrop, okay? We have a backdrop of an economy that's currently forecasted to grow 3% in Q3 as far as GDP. Real personal consumption expenditures growth is up over 2% in the quarter so far. Real gross domestic investment growth is up over 6% in the quarter. There's some very positive signs from the economy. Labor market maybe starting to weaken a little bit. But the backdrop here is getting a little bit more clarity on tariffs. Either we're going to have tariffs or we're not. Hopefully we get some clarity soon. But we have a Fed that is starting to be accommodative. Okay, and we just got through one of the best earnings seasons we have invested through. I'm assuming you started investing in the last 5 or 10 years. You have not seen another earnings season that beat expectations the way the last one did. So if markets truly revolve around multiples and earnings, the multiple should be, supported by the Fed cutting rates, the economy doing okay, AI, innovation, and growth doing okay, and then earnings obviously just beat expectations. So we do have a lot of positive backdrops that could keep September from being a terrible month, but it doesn't take a lot in this environment to get big down moves. And tomorrow there is a risk of that. Here's the deal with tomorrow. If it's way better than expected, that's bad. Potentially, okay? If it's way worse than expected, that is also bad. Now, I could sit here and explain exactly why too high of a number is bad or too low of a number is bad, and there's a lot of different intricacies here, but as I've talked about on the channel many times before, it doesn't matter if the Fed is cutting rates. Rate cuts are not in and of themselves a positive. You need to see an economy that is doing okay for rate cuts to be a positive. If the economy starts to look like it's falling into a recession, that's not good. Now, here's the secret that I will tell you. The economy doesn't just fall into a recession anymore. It's too big, it's too diversified. You need like a real event to give you a recession. Now, in my view, we are seeing the economic data from like May, June-ish, right? So I don't think the jobs report for August tomorrow is really for August. I think it's like multiple months behind. So could you see slightly weaker than expected jobs number or a bad jobs number? Maybe. Some of the tariff stuff was a little bit of a shock, not enough to give us a recession. Obviously, at this point, I think things have stabilized and really calmed down. The economy is just economizing like it has been, right? We're not in a recession. Okay, bottom line. Now, Wall Street, they get very emotional. They let emotions dictate their every thought. So if we get a bad jobs report tomorrow, what do you think Wall Street's going to say? They're going to say, oh my God, recession, blah, blah, blah. But if they truly understood the economy, they would know that the economy doesn't just go into a recession. When is the last time we have just went into a recession organically? Just like walked into a recession without like '08? That was obviously the crisis, right? We didn't just go into a recession naturally, okay? 2020, we didn't just go into a recession naturally. The dot-com bubble, we didn't just go into a recession naturally. In the 80s, 70s, inflation, right? There was a catalyst, okay? We haven't just walked into a recession without a catalyst in a very long time. And I don't think the temporary trade embargo on China caused a recession, or we would see it in real time right now. Now, yes, we're going to get some data that comes out rough this month and maybe even part of next month. That's why I really think the strong market rally happens about mid-October. First half of October, we could get some ugly data as well. But Wall Street's going to jump to recession conclusion, and that is an opportunity if we do get selling pressure, if we do get Wall Street that freaks out over that. Because if you're smart enough to understand, we don't just go into a recession. Okay, that just doesn't happen. Now, non-farm payrolls for August tomorrow are expected at 95,000 jobs. Last month was 93,000 jobs, or 73,000 jobs. We're expecting 75,000 jobs for tomorrow. So a little bit of a rise from last month. Now, here's the deal. I don't know if this means anything. This is the insight I'm going to give you. Trump fired the head of the BLS last month. He's going to look pretty stupid, to say the least, if we have a really bad jobs report tomorrow, because he blamed the downward revisions over the past 2 months being like 19,000 positive and I think 14,000 positive, something like that, were the numbers we had last jobs report for May and June. If we get a really bad number and more downward revisions for the last couple of months, that's not going to look good. So I think we are in favor of getting a slightly better than expected jobs report. Here's the deal. Anything below 50,000 is likely not great. Anything above 100,000 is likely not great either. So best case scenario is probably coming pretty close to the 75,000 expectation, maybe a little bit higher than that. Maybe like 85 to 90,000 jobs would be seen as a good thing, because that's not like booming. That still begs the question, we should be cutting rates, but it's not 200,000 jobs where it's like, okay, maybe we don't need to cut rates. Or it's not like, hopefully we don't get a negative jobs report tomorrow. Then it's going to be, oh my gosh, recession is here. We need to start massively cutting rates. Sure, would rate cut odds skyrocket at that point? Yes. But would that be good? No. Okay. The unemployment rate is also important. Think about all of the immigration that has essentially ceased to exist at this point. It makes the unemployment rate kind of tricky, because it can stay stable with a lower monthly jobs number. But if we start to come in like 50,000 or lower, the unemployment rate could go up rapidly because we don't have that extra supply of workers coming in. Okay. So you're expecting this to rise from 4.2% to 4.3%. Again, as long as this does not come in at like 4.4 or 4.5%, then we're good. Okay, you have participation rate, average weekly hours, government payrolls, all of that. And this is really the big event that Wall Street has been waiting for. And trust me when I say this, you're going to see a big move tomorrow. partially because of September seasonals, it's really going to amplify whatever we get tomorrow and the sentiment narrative that gets pushed. Let me tell you now, algorithms are already pre-programmed to sell stocks at a certain jobs report tomorrow, a certain number. They might be programmed to buy stocks, but not like you would see during like a normal market. So I do think you're skewed towards a downside reaction tomorrow, especially considering the upside that we did see in markets today. Now, does that mean we have to fall tomorrow? No. We could see stocks continue to do well, but we are skewed. We are fighting an uphill battle is essentially what I'm getting at here. Okay. Now, let's take a look at the final numbers for Tesla. Now, again, today we had big news that the robotaxi network is about to open up in the San Francisco Bay Area and Austin, Texas to normal people, okay? We were expecting this news in September. I think this is massive news. It takes the robotaxi from really a project to the mass market, okay? Can you really call the robotaxi like a mass market product if it's invite only? No. But if anyone can sign up and use the platform like Uber, then you have a real product. I think it changes everything from an investing standpoint, from Tesla's AI endeavors kind of standpoint. It actually puts them on the map to compete with Uber, Waymo, all of them. So I think that was a big deal today that Wall Street did not quite seem to grasp. Again, weak seasonals in September likely have something to do with that. And as we get out of September into October, November, December, you're going to see all of this good news, all of these positive developments come back and start to be a tailwind for Tesla stock. Don't think that Wall Street's just going to ignore this. No, it's a bit of a delayed effect in my view. We've seen this before. I've talked about delayed effects before, and I think this is a classic example of that. Even though Tesla did well today, I think Tesla would have been up 5 to 10% in a normal-ish market. Now, today you had 126 different trades from hedge funds and institutions, totaling $524 million with a positive order value of 49%. So pretty neutral as far as option activity, and you did have 710,000 shares that were on net sold short today. Now, I want you guys to take a listen to this clip on CNBC. It's from Ryan Dietrich, someone that's been very spot on this market, that just has been incredibly accurate. It would be a disservice if I did not show you this clip at least. He says, quote, "It's a healthy market. The baton is getting passed around." That is what I've talked about before as well on this channel, that you want to see red days. You want to see, stocks that can actually fall, because if you don't, you're cooking your way into a bubble, right? They say stocks take the escalator up and the elevator down, right? The more you get that chop, the more you inevitably delay that escalator, that elevator down, right? The more of a healthy market that you actually have. So take a listen. It's only about 3 minutes long.
Start with this. Yesterday we saw Alphabet and Apple really move the markets higher, but the rest of the tech complex, it kind of moved lower. Today we're seeing a bit of a bounce back. What do you think that says about investor sentiment when it comes to big tech and maybe even the broader market?
Yeah, great question there. The broader market, we're in September, right? As everybody's been talking about, it can be potentially choppy after a 30% rally. We think it makes sense. It's kind of that dispersion. Look at the market. Yes, tech is, I know it did okay yesterday. It started to lag a little bit. What's been leading? Energy, material, some of the stuff that's really, really small that honestly doesn't move the needle all that much because tech is so large. But I think that's a healthy market, kind of that baton getting passed around. Overall, we are still slightly overweight technology here. But if you talk about what's one of my one of my near-term worries, Frank, we are seeing a little bit of relative strength weakness out of technology. And like you said, it's kind of bifurcated, I guess, with some of the leadership. But big picture, to put a bow on this, we still do like large caps over small caps. And I know that's kind of been an interesting discussion last 5 weeks or so. But the reality is, again, we like large over small. We think large cap tech still will do pretty well here going forward.
Just to your point about the energy space being smaller, our friends on Fast Money, they were saying last night that NVIDIA is twice the size of the entire energy sector when you're looking at market caps. So just give you a sense of where energy is these days. I'm going to go to some of your research. So We're worried about some seasonality, specifically with September. On average, over the last decade, S&P pulls back about 2% in September. So seasonality is a thing. But you gave us some other stats that I think are pretty interesting. So you say after the S&P's been up over 25% over 100 days, the average return after 1 month, that's 1%. The average return over 3 months is just about 6%. Does that mean, because we've certainly been up over 25% over the last 100 days, does that mean that you see the market rallying all the way into the new year?
We do. And, Tuesday was 100 trading days off of the April 8th lows, so the lows of, the near bear market. And near term, sure, that's extended. But again, 3 months later, like you just mentioned, higher 11 out of 11 times. So never lower 3 months later is what I'm getting at. So any seasonal weakness, maybe some strength. And a year later, up like 13% on average. This is just one stat, one statistic. But Frank, I've come on with you for a while saying the strength we've seen off those lows is not consistent with the bear market. We know we're not in a bear market now, but it likely does say we're still higher. We've got advanced decline line strong. And you talked about bonds. I want to touch briefly on this. Obviously, the 30-year yield is up around 5%, highest in a long time. All over Europe, long-term yields are breaking out. We do have a steepening yield curve, though, again, as the 2-year yields aren't nearly as high. But the reality is, what are the credit markets saying, right? I'm an old school John Murphy disciple, message of the markets. Credit markets still are showing virtually no signs of stress, no worry. So to me, if the bond market is going to spiral out of control, we'd see some warnings in high yield, junk bonds, credit spreads broadening out. We're not seeing it, Frank.
Ryan, I got to be honest, we're going to do bonds a little bit later in the show. We want to stick with equities with you while we have you very quickly. So I want to talk to you about what's coming up tomorrow, the jobs report. What are your expectations? How do you see it impacting the market? I was talking to a number of chief investment strategists and chief equity officers yesterday. They said that, the estimate's 75,000. They say if it's above or below 10,000 of that number, they see a market move. If not, they don't see it having a big impact. Agree or disagree?
No, I agree there. We think kind of the worst of the economy was, again, a couple months ago, right when all the uncertainty over tariffs were there. Might come in a little bit higher than expected. It's going to be real interesting. Let's say it comes in much better than expected. I mean, who knows, but it could. I wouldn't be shocked by that. That might upset the apple cart a little bit, get that September volatility kind of pushing back on a Fed cut. We still think the Fed's going to cut in a couple of weeks, but maybe you're supposed to cut 6 times the next 16 months. Or maybe they don't quite cut that many times. Again, as the economy does a little better is kind of how we see things playing out.
So I'm just going to go ahead and leave this video off with that. Keep this one kind of short, sweet, straight to the point. I do think tomorrow you're going to see a lot of volatility. Markets are going to move a lot. But the fact of the matter is, it doesn't mean anything. You gotta just look through September. Honestly, turn off your phone. Don't even pay attention. October, November, December, that's when things are gonna get pretty crazy. Hit that like button, subscribe to the channel if you have not done so already. It's free $99. It costs you absolutely nothing to do so. Check out that link down below in the description of today's episode if you guys want to come join us and come win with us. Okay, the trading community portfolio today, even though markets are green, is up 3%. That brings the year-to-date performance return, not including about 20,000 that I put into this portfolio, to 96.55%. We are beating 99.9% of other hedge fund and institutional returns. Check it out. It speaks for itself. Do not be a jackass. Come to your own conclusions. Understand the companies that you are investing in. You could lose all of your money. This is not a recommendation nor financial advice. What we are doing is going out, finding small cap AI stocks before Wall Street knows they even exist. We position before Wall Street. Then Wall Street positions. Then the catalyst, the news comes out. The stock explodes and then retail buys in. Retail is generally late. By then, we've already made a crap ton of money. That's the strategy in a nutshell. Check it out if you would like to. Link down below in the description of today's episode. Have a fantastic rest of your day, and I will see you in the next one.